Hello and welcome to this week's Closing Bell. I'm Callum Newman, and as ever, I'm joined by the star of the show, Murray Dawes, our chief trader here at Fat Tail Investment Research. We're going to be talking about some very interesting things in the market this week. One is a little flash crash, if you can call it a crash, a bad day during the week, but is that a sign of worse to come? Murray's going to look at the bond market, which might cause volatility as we go towards the end of the year. We've been asked to take a look at iron ore and a stock called GQG, which I know a little bit about. So we're going to talk about that. And then there's a few observations from the small cap sector as well. So, Murray, how are you going?
I'm great, mate. How are you doing?
Good. And I should say, just to start, we're going to go a shout out to Karen, who we met last week. So Murray and I, after the show last week, we went to the South Melbourne market for lunch. We had two laxers and we got a tap on the shoulder. Oh, you're Murray and you're Callum. And the lady
someone actually watches the show.
Yeah. And
good.
The lady had bought PLS,
PLS,
yeah. After Murray's recommendation and made a few bucks. And I think you said, well, are you going to hold on to it? She's like, I've already sold it. I've banked the win. I'm good. So shout out to Karen.
Run
Thanks
your
for
profits.
Watching. Yeah.
Yes, no, nice when people come up and say hello.
Yeah, even if she doesn't listen to your rules about,
Yeah, exactly. It doesn't follow what I actually tell them to do. Everyone makes up their own thing, don't they, in the markets?
Cool. All right. So the market is up today, probably up for the week. I didn't actually check, but we did have that sharp sell-off
160 point smashing
during the week. And then suddenly it was like, oh, is this
what's going on? Is this
volatility? Is this the top? You have been talking about bonds for a while. They are starting to press up those yields. That is likely to pressure the stock markets if it goes any higher.
Keep going, yeah.
So what are you seeing on the charts, Buzz?
Yeah, well, let's start with the bonds because I've got the chart up there anyway. Then we'll maybe have a look at the ASX 200 just to get a sense of what that move looks like on the charts. And I don't usually freak out from one day's trading. I wait until we get a bit more of a sign because that might just be one day and we might be going up through the highs next week. You don't know. But I wanted to look at this chart in particular, which is the US 30-year bond yield minus the US 2-year yield. So that's sort of one calculation of many that you can make, I guess, of the steepness of the yield curve. And what's interesting about this one, this is going all the way back to 1989. And what I guess I want you to note is that we are currently seeing a pretty sharp steepening of the yield curve at the moment, which may only just be getting started. And you can see that during that 2023 period, I mean, it went negative, right? Negative 1%. So the short-term rates were higher than the 30-year bond yield. And that's obviously a very rare occurrence. You got it, went back to that sort of level back in 1989.
That's the inverted yield curve, what they call the inverted.
Yeah. And then we've got the back in 2000 as well. You had it happen. And look what happened. Each time that it did go down to below zero, to that inverted yield curve, look at the moves that the yield curve had coming out of there. From 2001 up through to 2005. They've pretty much nearly every time topped out with that yield curve going all the way to about 4%, 3.5%, 4% you can see there. So at the moment, we've got it around, 1.25%? And I've been talking about this for the last few months. And since I've been talking, it has been steepening further. Because we've got this situation, haven't we, where the Fed may be getting taken over by Trump. And everyone's thinking about that. So that could be a big problem because inflation's running pretty hot still, and we've got rates around 4.25%, whatever it is, core inflation around 3%, and now Trump's saying, "Oh, you've got to drop rates because unemployment number wasn't that good."
Yeah.
And he's putting a lot of pressure on Powell. He's going to put his guy in next year, and he's sacking that Cook governor and seeing whether he can get away with what he can get away with.
I think he's going to get away with it.
So if he does try to really pressure down those yields, he may be doing it at a point when inflation still is quite high, and he could ultimately set off inflation again. This is the issue that people are thinking about, which is why the long end of the yield curve is actually going up. So he might.
Yeah, so the Fed controls the short end.
Yeah, Fed controls the short end, but then people might say, well, what's going to happen in 10 years if Trump's in charge of real estate developers in charge of interest rates? What's he going to do? Any sign of any problem? Let's lower them.
Yeah.
So, and what's going to happen then? Could inflation really get away from us again? It could. And so you're going to demand higher yield, aren't you, to hold something for decades, the risk of that. But we're seeing this all around the world. Now, we had Japan went off their yield curve control, so they were managing their yield curve, where they buy the long end of the yield curve, those long-term bonds, keep the yield down. Now, they've backed off from that start of last year, and now their yield curve is getting really steep, right?
Yep.
Their 30, 40-year bond yields going way up. The UK, France, they're really starting to go. People talking about fiscal worries. But I'm wondering whether there's also a bit of Japanese life insurers selling, because they've dropped 80 billion in the first quarter, and it's been more since then because the long-term bonds have gone up since, which means the price is going down.
So they're getting slaughtered on their portfolio.
Slaughtered on their portfolios. So are they selling offshore to cover some of those losses, repatriate some money and cover some of their gaps in their balance sheet? That could be happening.
Could be.
So there's a lot of things under the surface there that can end up bubbling up, where we've got gold breaking out to new all-time highs, silver absolutely going ballistic, and I think could really keep going. I've been talking about that for months, if you've been watching. So we're seeing these signs that can sometimes be a bit of a hint, a canary in the coal mine, where you've got long bonds getting absolutely slaughtered, gold starting to really fly, silver flying, a bit of a flight to safety asset sort of thing. Is there something underneath the surface that the big boys and girls know about that we don't really know about yet? Is there some massive life insurer about to go belly up that's going to create contagion across the world's markets, and there's going to be forced selling of, like, who knows?
Yeah.
Like, there could be something.
So what
you really, the surface.
What we're really tabling is, it's been a fairly smooth ride for the last, since April, really.
Yeah.
So volatility, as those concerns wash through, is probably going to start to get yanked around, I would assume.
Could. And we're going to September, October.
Yeah, seasonally, usually. And I just feel like this is going to carry on, like the tussle between the tariffs and the deficit and the yields. It's going to start gyrating things around, I feel like, more so than we've had to really deal with, except for the sell-off in April kind of thing. So I'd expect that to throw around some opportunities as we're coming up. But it was interesting too on that day that we had the sell down this week, that the gold stocks were up and about. So I felt like they were a good hedge for that sort of situation. So they're doing what you want them to do.
Yeah, exactly. No, that's why I'm running some gold positions where we've taken all the part profits, and I'm just happy to, leave them and see what happens. So here we've got the ASX 200, and the reason I have that black line there is this was the previous high, right? So there's your previous high from, what was it, March, Feb, I think. And that's when we went into the Trump tantrum. So there's that massive smashing we saw. A huge reversal, and it's taken off and broken out above that level. Now, this is where I've been sort of saying, look, it could be a serious breakout, and this thing may fly higher, but this is where it's at risk of potentially creating that false break. If it breaks down through that level, going below that high, that's when you can have quite a serious correction. And, so what? Maybe down the track it ends up finding buying pressure and we're off to the races again. Fine. Long-term uptrend still all in place. But my point is that there's a time to trade, to be buying. When you've got a big sell-off happens and things turn up and starts looking good. Okay, that's your point when buying, it makes a lot of sense than having a crack. Up here is when I'm just a bit warier. That's when the amateurs are really saying, oh, it's broken out and it's going to go up forever. And often it feels comfortable buying. It's been going up for months and months and months. This is just the area where I'm like, well, I'd rather be watching and waiting and seeing what happens and not adding too much risk, because there is a chance that it could ultimately have that false break.
I was going to say, as is the way of markets, like down at the Trump at the bottom there, it felt uncomfortable buying.
Absolutely, yeah.
But that's obviously
that's just how it moves, isn't it? That's how it moves. I mean, markets always look good at the top and terrible at the bottom. So that's why I'm just, I still am, I guess, bullish and happy to be long. But that 160 point fall is just that, for me, that possibly the first sign of something to come. But then I'd go to the weekly charts.
And it came out of nowhere, right? Like you just wake up and you're like, oh, the market's just, today
all of a sudden
we're
absolutely
down,
hammered.
But you don't know why, or
you
couldn't see it coming and such. It was just, there was no indication that it was coming.
And when you look on the weekly chart, still a weekly uptrend, it bounced off the 10-week moving average there. It's still well above that high. So, there's no need to totally panic yet, but it's possibly the first sign of some sort of topping formation. So for me, it's not time to run away. It's just time to prick up the ears, look at those bonds. Are they going to keep selling off? Could this be a bit of a sign? But you got plenty of time to.
Now, we should say too that
something.
valuation-wise, the ASX is up there. We don't really have the earnings growth, and we don't have the big tech sector like they do in America, kind of thing. So it kind of feels like there's no strong impetus to keep pushing the market, the ASX 200, driving up and up and up
and up and up. You wouldn't think so. I'd say my gut feel is always I'm wary of the false breaks. It's just false breaks happen far more than breakouts. You look back here. There's the high, right? Things rallied for months. Now everyone there was going, oh, this is going to go up forever. What ended up happening? The false break, and it went nowhere for 2 years before rallying again. So this is just sort of that situation where you've got to be wary of that sort of thing. And look, we may end up going higher. There's still a long-term uptrend going on here, but just this is sort of that moment when I'm just a bit wary. And look, if it all turns up and the next couple of weeks it breaks out and it's at new highs again, fine. We're long. I haven't dumped anything. I'm not running scared. I'm just saying this is sort of that area, though, where tops can end up forming.
Well, we did have a subscriber ask about iron ore, and I guess this plays into the thing because you kind of feel like if the Aussie market was to really run, it has to come through mining, which has not really been happening lately. Now, you have said openly in the past that iron ore has never been a strong market for you to trade or to make sense of. But what I do know, for whatever reason, I follow iron ore and have for a long time.
I'm having trouble finding the right one.
Well, it doesn't. Yeah, its futures market is weird, right? SGX will be it. If you get the Singapore contractor,
there we go.
The investment banks at the start of this year most of them were assuming that iron ore would be going towards $80 a ton. Now, as it is, it seems to be doing better than everybody thought.
Yeah, I really thought it was going to come off.
Considering China's news is a bit neither here nor there, that the
real estate is it and coming online,
new West African supply kind of thing. So on the whole, you'd say iron ore is resilient. There's good cash flows for the bigger guys. But that said, as a trader, with something like gold, you have a big story. It's about the deficit and people sheltering from the system and yada yada. There's no real story.
As a trader, look at this.
Yeah,
that's the last 2 years.
And so
for me, it's I'm not even looking at it really.
So what I mean is for a stock to go up, obviously you need the earnings to go up or the premium that the market is prepared to price into that stock to rise. And iron ore just doesn't attract that widening of that premium because there's just no big narrative. You need a big China. Look at when when it was screaming up in 2020 when it went to over 200. So that's price driven. Or people believe that there's this wave of infrastructure coming and everybody wants to buy iron ore. You just don't get that in iron ore. So a lot of the stocks, especially the smaller ones, will trade on 1 times cash flow or whatever because there's just no premium into them. It's just it's very hard to get going. So in terms of the chart, it could go at $100 for another 6 months. It doesn't give you anything.
It's really died, and I mean I did call it negative once it failed here, so people can go back and see closing bell. I'm sure you won't, but it's a pretty clear ABC correction to the upside. It was in downtrend. You can see there. It rallied to the sell zone of this wave. So the sell zone of that wave comes in around here. So it was a beautiful technical setup up there. And I said, look, this is a short, watch out. And since then it did sell off, but I've really been expecting it to roll over again. I've really been expecting it to roll over all the way to retest the low of the whole structure. And it may still do that. It may still do that. But at the moment, it's holding in there pretty well. I was sort of expecting it to continue with weakness, and it hasn't done that. And I can't call iron ore that well, especially when it's doing nothing.
Well, I don't think anybody calls iron ore.
And it's just, but it's been surprising how strong it's been from here.
So
But it's at 105 and holding in there. So look, maybe that gets snuffed out and it gets smashed again soon. But
the flip side though is if it did go for a run, that would be an unexpected outcome. Right?
Yeah, absolutely.
And then the stocks, related stocks, would respond positively there, and I wouldn't mind that because most of them are cheap and unloved and that type of thing. So that can give you a good risk versus reward, but we need the price to do more than what it's doing now.
Yeah, it's still not convincing to me that it's definitely going up. It's still in long-term downtrend. This could just be a short-term rally. I know the Chinese property market is still in trouble, and they've had a lot of production that was already on the books for years, so they've got to build it.
Yeah, they were
building it. So once that's built out, that there's probably going to be a drop-off in the intensity. So
that said, though, outside of iron ore, I feel like mining and mining-related names are warming up a little bit. I've seen a lot more juniors come through the new highs list. Some of those mining services stocks have done really well over the last 12, 18 months. But we did have a request from another reader to take a look at a stock called GQG. Now, I know more about this one than you in this case.
You definitely do.
But bring up the chart. So this one was a really good performer for me.
Oh, I think I got the wrong one.
No, that's it.
Is that it?
That's it, GQG. Yeah. GQG Partners, which is a fund manager. And this broke out in 2023 and had a big run up. And it's got into a little bit of trouble. Now, in the context of your model, it's probably getting towards closer to the buy zone than the sell zone, I imagine.
Yeah, but it's also been
or a bit neither here nor there, is it?
Well, it's been trying to bounce, and it's not doing a very good job of it.
No, and I'll explain why I think
here,
that is.
So it has, it's had that first wave, sold off to the buy zone, didn't quite get there. So there's sort of the area where I expect it, but it's bounced off there twice. So we've had a couple of attempts to rally. We've had a lot of buying going on, thinking they're capturing it, and now it's retesting the low. So actually that looks like what you need to have is a clear out. And then potentially if it turns around, it'll be a buy. But you need to have the people who have bought in here for the last year or so, you need to get them shaken out, and then you might end up setting up something. So I'd sort of be wary of that one right now.
Yeah, well, I was just going to colour it in a little bit. So it's a fund manager. It listed 4 or 5 years ago, and as you can see, it got caught up in the bear market there. So back in 2023, it was adjusted for risk. It was a good idea. So actually, that was one of my ones at the speech that we did, Fat Tail Ball or whatever it was, and it did really well for a while. Now, what happened at the top? I think it just was a valuation thing, but basically their funds under management have stopped growing for the moment. So you don't know, like it could get better if it's going to go well again. And also the guy behind it has pulled his money away from the US stock market because he thinks it's a bubble and it's overbought and all this sort of stuff. But that's now costing him performance because when obviously he's been missing the upside that the US has given lately. And so he's losing a bit of funds as people leak out of his fund, basically. So it's very cash generative. Now, if you bought it around today, you get it like a 10% yield. Like it makes a lot of money and he pays most of it out. So that's why it probably has good support towards the bottom, but it's not. It's why as it lifts, it gets pushed back down again because there's no growth in it at the moment. Right. So he needs to start growing his funds under management. So that could conceivably do nothing for a year, but then if his strategy starts working again, he starts getting more funds under management, well, then the market will start bidding it up again, or could start bidding up like we saw in 2023 when it really started to move. Now, that was also too the markets breaking out. So, of course, a fund manager is always going to do better when markets are rising and than when they were in tough times a few years ago. So it's worth keeping an eye on. If you're interested in yield, it pays a good yield, and you could get a bit more of a downside, but I wouldn't think it'd be too extreme. And again, keep every month they do their funds under management. If that starts to turn positive, well, obviously the market will get behind it a little bit better. So it's one to keep an eye on, but not to buy next week, I don't think.
Right.
So that's GQG. Now, I was going to give you a treat today, Murray, and that was the new sales chart of vehicles in Australia, which I saw on Twitter, and Belvedere will bring this up via ComSec. So it says that in August, Australians bought 100,000 new cars, which is the second strongest ever in August. And so we've been talking about the strength in retail stocks lately and the consumer. And that to me would be another sign of strength, obviously, that people are comfortable
the
to buy a new
GDP
car.
numbers out during the week definitely showed that the consumer was starting to pick up pace a bit with rates coming off the boil. I guess mortgages lowering a bit and people starting to step up their spending. So that's sort of interesting as the bull market actually getting some traction.
Kicks in, yeah. We'll bring up a stock called PPM, and if Ryan Dintz is watching, he'll laugh because he likes to tease me about Pepper Money. But so Pepper Money is what they call a non-bank stock. And so I made the case for some of these back in 2023, saying they've been completely dumped and you could sort of go bit bargain hunting. Now, Pepper does not just mortgages, but also car loans. So when I see the good sales figures, obviously some people may go to a financier to pay for it kind of thing, which Pepper is. So you can see that Pepper this year has finally broken out of that sideways move.
Yeah.
And there are so many small cap stocks that are doing that.
Yeah.
So the non-banks are some, the mining service stocks, some of those junior miners. And that to me is a sign that the bull market is going from the top and now it's starting to seep through to the bottom in a strong way. Now, Pepper is a good little business. It's got lots of cash, good funds assets under management, pays a good yield. I don't know if it would go crazy like some of the other small caps because it's domestic, focused on Australia. But overall, this is a thing that can kind of trend for a little while, 12 months, maybe 18 months before it runs into its limitations. But there's a lot of charts like that at the moment. So point being, there's a lot of opportunity around.
There is. It's been a really fun time.
And backed up by the data improving with car sales, net growth in mortgages, consumer spending, yada, yada, yada. Well, so, I mean, it is logical. The market is doing what it's supposed to do. The odds of Pepper making more money over the next 12 months are getting better, so it's getting marked up. What are you going to show us?
Well, just to say that the S&P, we had our 160-point smashing, but the S&P hasn't missed a beat. This is, let's go to there's a monthly. You can see that it's just about to break out to a new all-time high. I mean, it's a long-term uptrend. You've got the buy signal there. It's taken off to a new high. It's still marching higher. See those bars marching higher, the key bars? I mean, there's nothing saying this isn't going to do that. Any moment it can have a correction, but
or an event, something
like if those interest rates, as I was saying, just start to really rocket higher. But from this point of view, I mean, it's at all-time highs and trending. I mean, we could be at this point here, and about to see months and months before it ends up having its correction, which will come at some point. But at the moment, you're really running things and seeing how high it can go.
Yeah, and that's I'm just thinking like Pepper Money and what, as you said, you trade and we'd look at individual stocks. So as long as the general market's holding together, those smaller stories can just sort of play out under their own wings. And we should let's bring up 40X just as an example. This is an extreme example of things going crazy well. So this is a little small cap that has gone absolutely bananas over the last week. Now, I'm not saying this is in any way typical of things, but you can sort of see that this is not a typical one, but an example of listed in 2021, the small cap bear market pretty much for the whole time. But underneath the chart there's still the company doing things, working towards things. Now, this is a med tech company that just sort of got approved for reimbursement in the US and approved by the FDA. So getting into the American market basically, and look at the response from the market with those approvals. It's up nearly 200% in the last week or something, and gone from 20 cents to $1.50 there.
Yeah, massive move. And you can see again the clear sort of rounding bottom. You had the unfortunate new investors getting absolutely hammered. And then the clear out, and then you've had the attempted rallies, but because you've got so much pressure on the stock, whenever it tries to rally, you've got the selling pressure still there. So that's where you get that rounding bottom.
I had a crack in Australian Small Cap Investigator in 2023, right? And then somewhere we were, I think, in that jumpy bit. I can't remember now, but yeah, it didn't work. We got stopped out of it. And look, it's ground.
And this is where
grinded along for another 2 years, and then suddenly it all comes together and goes up 200.
And you can see how it broke below that low. So there's your low of the whole structure. You've got all this buying going on in here of people trying to pick the low, and all their stop losses are going to be down here. So then you've got this period here, which would be a big stop out, and this is where you get the false break. So the false break of that level is there then when you get, pretty much everyone's exhausted, everyone's out, you get a final stop losses going off below that key level.
And then the big news comes in.
And then bang, it takes off once it does rise.
So it just goes to show that there are so many stories, especially once you step outside the top 50 type of thing, where a huge game. I mean, EOS is another example recently that's just gone completely bananas. And again, as we were saying off camera, that sort of stuff wasn't really happening a couple of years ago.
No, it's a totally different market.
Now suddenly things are happening, and it's like, wow, I can't follow every single one. Like it's sport for choice kind of thing.
Yep, it's fun.
So make
Finally,
the most
it's a
of
bit
it,
of fun. Yeah, no,
yes.
You got to make hay while the sun shines.
So there's a few others. So we should also say, actually, I've been thinking about this actually because I've been talking about the market recovering and going up for a good while now. So it's like things are getting repriced. There's not as many bargains, like no-brainers, if you like, that there were before. But resources are one sector that still could come back in a big way. And
I think uranium's just getting started again
we talked
after
about uranium.
a year of selling off.
And we've chatted about lithium in the past.
And rare earths and
So if I had to pick a sector where you can see some extreme moves, it's going to be some resource related, I think, because it'll be drilling results or
silver's going absolutely.
Oh, we should talk about silver. Actually, it's probably now silver's the best
because you know that. And remember, people might remember. I was going on for months about this structure here that once it broke out above $35, like it was caught in that range. And I was saying, look, once it does actually break out above there, it's going to absolutely fly because we're looking at this wave here.
And it's no exaggeration. I've been waiting for silver to break out for 15 years. Like I've been hearing about silver.
It's been terrible, hasn't it?
But it's just like...
So you can see that last run up to $50 and then massive correction all the way down to that buy zone area. So we've had a huge clear out of positions. It had the rally to the point of control. There's your midpoint. Couldn't get through it. So we had another sell-off back to the buy zone. So once it's broken up through that point of control, you're basically giving it targets up into this sell zone area. And that's what I've been saying for months. Saying, look, watch out here. If it does actually break out, this thing can just trend very fast up into this area. So really, this can head higher up to $44. And look, maybe it's just going to trend straight through to 50.
Well, it's similar to
we don't know.
Uranium,
at the moment,
right?
It's trending. You've got to let this thing go. It could go a long way.
Well, I think it's like similar to uranium in the sense of nobody's cared about silver miners for like the last 15 years, right? So they've slowly whittled away to the very few that are left, or it's usually a byproduct kind of thing. But that sets the stage for that explosive move because you have heightened interest in precious metals because of the global financial concerns with the hard money versus paper money dynamic, the narrative, if you like. And underneath that, you have a metal that's done nothing for us, so nobody's invested about it, nobody cares about it, suddenly ready to explode. So it's just like stuff like that we didn't have a few years ago, where it's like there's so much stuff you can look at.
And platinum, looking interesting too. It's probably gone pretty hard already, but I think it could trend pretty hard as well. It's been this is the sort of thing. It's been doing lots of work for years.
Yeah, same
since
reasons.
2015. So it's been doing lots of work. Everyone thought it was all over for it. Catalytic converters don't need it as much in an electric vehicle, do you? So they're not going to have any demand. And now it's like, it's hybrid though. Hybrid, they need more. And so now it's like, actually, platinum could really be needed.
And probably half of it comes from Russia or something. Like it's one of those obscure ones where I don't even know the supply chain on platinum.
Yeah. So does this can it go on one of these sort of moves? So that's what I'm trying to position myself for. That sort of thing.
Well, there's certainly lots to chew on.
That's it.
And again, with your new service, International Trader, you have more scope for doing some of these more bigger stories as well. So that's pretty exciting. So we'll leave it there for today. I guess we'll just say, in a weird way, offsetting each other, lots of opportunity, but big potential for volatility on the other side.
Yeah, the next few months may see some sort of correction.
I'm kind of thinking the last few years has been about the reflation of things getting back to normal. Now it's kind of like conviction trade. Like you only want to get into something if you're prepared for like some big sell downs as things wash through and all that. So different kind of strategy compared to the last few years. All right. If you enjoyed that, give us a thumbs up. If it's probably you can't join your service anymore. Can
No,
you?
no one's
you missed
allowed.
the window.
No one's
All right,
allowed.
maybe next time.
Of course you
you're
can
still doing-
join. It'll just cost you a bit more.
Oh, right. Okay. All right. You're interested in Murray Services Retirement Trader, which is Australian focused, or international, which is more US.
Get in touch with me. I'll make you a deal.
You can get in touch with Buzz. Otherwise, that's it. Hopefully we see Karen down at the market again. And as ever, leave a comment, or if you're interested in Murray charting something or something you want us to talk about. Otherwise, we'll see you next week.
Check you later.